the price take out this fair value gap, which is now the internal liquidity. So, hello, smart trader. I want to talk about how you can effectively use your fair value gap as your internal liquidity. First of all, what is internal liquidity when we are talking about price structure? Internal liquidity are those liquidity that are resting within a swing high or a swing low. You understand? Remember, mark that word is within. You understand? Not at the extreme of the swing low or the swing high. So let me show you how this thing typically is represented on our chart for us, for the sake of those guys that don't know it. You understand? You know, price normally move in this format. You understand? It is not just simple higher high, higher low. No. It's not simple like that. If it was that easy, everybody would be making money off the market. It is not just simple like that. You understand? Price don't just move higher high. No, this is how price typically move. You see something like this, price will move like this, create something like this. You will be thinking that okay, this market want to fall and it will go up again, come down, and thinking that it want to fall, but it will continue towards the upside, printing another fresh higher highs towards the upside, right? And you see the market continue doing this thing, you understand, like that, take out this low, and boom, it continue towards the upside again. This is typically how the market move. It is not just simple uh higher high like this, higher no, higher high, higher low, simple like this. No, it's not that simple, you understand. If it was that simple, everybody would be making money off the market, you understand. So this is how this thing works, you understand? And mind you, this is the external liquidity here. This here is the external liquidity, and this here is the external liquidity. The swing low and the swing high. The swing low and the swing high are the external liquidity. Some of you will be like, where is the internal liquidity? This is where the internal liquidity comes in. This is the internal liquidity. You see this failed what will I call it? A failed swing low, you understand? You understand? It is the internal liquidity. And mind you, within this type of internal liquidity, you can equally see a fair value gap within it. There's an imbalance that is always created. You understand? And the market will come back, hunt for that imbalance, and equally take out the uh, the the the, the failed swing low. You understand? You understand? So the market will take it and equally take the fair value gap as well. You understand? Then it will continue towards the upside, printing a new fresh of high, taking out the external liquidity. This is how the market typically wants. It will just continue like that. See this particular internal liquidity again. It will go up, come down, and claim it before printing another fresh high towards the upside. This is how the market moves. You understand? It is not simple higher high, higher. No. It's not that simple like that. And if you understand the mechanical way that the market does moves, you are going to be far ahead of people. You understand? So let me show you how you can utilize fair value gap as your internal liquidity in the market. Since you understand the concept of internal liquidity now, let me show you how you can use it on your chart effectively. So if you look at this place, you will discover that the price has been pushing towards the upside, right? Look at this place critically. What can you see? You see that the price is moving towards the upside, creating fresh higher highs, higher low, higher highs. You understand? Higher low. Remember what I told you in the initial video, that in the beginning, you understand? I told you that you will likely see a fair value gap acting as your internal liquidity at some point, and this is it. This is it right here. The gap between this place. Let me pick my pointing to, you understand? This place right here. The gap between this candle, this particular candle, this first candle right here, and this third candle. You understand? You know, if you look at it critically, their wick does not overlap. That means it gave us a perfect fair value gap right here. And you see the price repricing towards, because of course, we all know that whenever there's a fair value gap, market tends to reprice into that fair value gap to balance the inefficiency in the market. So the process of balancing this inefficiency create opportunity for trader. Once trader have spotted this fair value gap, all they need to do is to just wait until price take out this fair value gap, which is now the internal liquidity. You understand? Price move from internal liquidity to our external liquidity. That is how price moves. If you look at this place again, look at what happened. The fair value gap here, price tap into it. You understand? Price tap into this external liquidity, internal liquidity, which is the fair value gap, before going for this external liquidity right here. And this is how the market moves from internal liquidity to external liquidity. From internal liquidity to external liquidity, continuously like that, you understand? And look at this place again. Price move into this internal liquidity, which is the fair value gap, before it start pushing towards the upside. So if sometimes you can use this thing as your confluence, don't just buy when the market give you a fake signal around this fair value gap. Wait until the fair value gap is completely engulfed. You understand? Before you go for any buy or sell in the market, if it is a trending market towards the downside. But in this case, it is a trending market towards the upside. So you wait, let the fair value gap be taken before you tap into your order block. It gives you extra confirmation. Don't be in a haste to jump into a trade when it has not yet materialized, when it has not yet completely taken out this internal liquidity. You understand? Once the market takes out this internal liquidity, be rest assured that whenever it taps into your your order block, provided you have established a trend that, oh, this trend is a bullish trend, and you have established that order flow, be rest assured the moment the market takes out into internal liquidity and equally tap into your order block, it is going to be a straight buy towards the next external liquidity. So this is how the market move. Remember, the market move from internal liquidity to external liquidity. Once you understand this concept, you not just go into the market and be doing something randomly anymore, be doing things randomly anymore, because you have a robust knowledge of how the market does work. You understand? So let me show you real life example on NZD/USD for those guys that may, for those of you that are like that are doubting Thomas. Let me show you real quick. Before now, the market has been pushing, towards the upside, right? You understand? Before now, the market has been pushing towards the downside. Look at the market. The market has been moving aggressively towards the downside. You understand? And all of a sudden, it creates a new higher high towards the upside. Look at this higher high here. You understand? So it's now changed the whole direction towards the upside. And if you look at it critically, you see that the market is leaving internal liquidity as it is moving towards the upside. Look at this internal liquidity here. Look at this fair value gap. So the moment this fair value gap is created and you know that this is a bullish trend, you don't need to buy here. Of course, it is a bullish trend, but why would you want to buy here when there's internal liquidity here? You wait for price to reprice it, you understand? Reprice into this liquidity, in this internal liquidity, and this is exactly what the market does. This is exactly what the market did, rather. The market replace into this liquidity, you understand? The moment it reprice into this liquidity, it now gear up and buy aggressively towards the upside until it takes out this in external liquidity. Look at this external liquidity. Until the market takes out this external liquidity right here, and it continue like that, it will create another imbalance again. Look at another one. Look at another imbalance. Look at another fair value gap. The gap between this guy and this inside bar candle here. Look at what the market did. Remember, the market come for it. You understand? It doesn't just go up. The next bullish candle doesn't just go up. It came back into that fair value gap, using it as the external liquidity before it start pushing towards the upside. I can go on and be showing you that this thing does work in the market. You understand? If you want to consider, let's say you want to consider a bearish scenario, look at this scenario here. This is a bullish order flow towards the downside. This is a bearish order flow towards the downside, you understand? Look at internal liquidity. Look at the fair value gap the market created here. The gap between this candle and this third candle. Look at what the market did. The market came back right into after it created this swing low. The market go back creating another swing high. Lower high, you understand? To take out this fair value gap, this initial fair value gap. Look at this initial fair value. The market price into it, take it out before it continue towards the downside. You understand? Further establishing or supporting this concept of price move always move from internal liquidity to external liquidity. The moment it move from this internal liquidity, the moment the price move from this internal liquidity right here, look at this internal liquidity, it move from here, it went straight for this external liquidity. Look at this external liquidity now. The market went straight for this external liquidity. Look at this external liquidity, and it creates a break of structure. Remember again, it's equally left behind another fair value gap while it was trying to break this guy here. Look at this fair value gap. For those guys that cannot see the fair value gap, let me use something to point it out clearly for you guys to see it. Look at it. Look at the fair value gap. The market left a fair value gap behind, and look at what it does again. It did again. It came right back into this fair value gap again, and it started pushing towards the downside. So the market is not random. It is not random at all. It is logical. It is a representation of what people are doing, the thinking of human being. You understand? This is what the market does. But if you don't understand it, you'll be feeling like it is random. There's no randomness in the market. Once you can read the chart clearly, you can see that it is not random at all. I can go on and show you that this thing does work in every other pair. Let's say we are using maybe JBP or maybe JBP JPY, for example. Okay, this is JBP JPY. You can see that we have established order flow towards the upside, bullish order flow for that matter. You understand? And what can you see here? We are seeing that at any given moment when the market creates internal liquidity, look at this internal liquidity, which is the fair value gap. The market price into this level again, giving us a fresh new high before the fresh new high continue towards the upside to take out this external liquidity. And it continues like that. This thing, it is perpetual, it is repeatable, it is logical. You understand? If you can see it, if you have seen it, you can never unsee it. You understand? Look at it again. The market printing another level again, another fair value gap. The market tap into this level again, it continues towards the upside. It is logical, it is everywhere in the market. You can use it to help yourself to better understand the market and trade effectively. So once you understand this thing now, it will now make more sense for you to wait when you have spotted another block. It will make more sense for you to wait for that block to materialize. You understand? You understand? Because once you know that, okay, look at this particular example. Look at our order block here. This is the order block here. You can see this is the order block here, and you see an internal liquidity being created. So once you see this internal liquidity being created, and you know that of course there's a order block below, you know that okay, price will definitely go for this internal liquidity. Since it will go for this internal liquidity, the higher chance of it tapping into your order block is there for you. So there's no point of rushing the market once you have all these things at the tip of your finger. You understand? So I hope you have learned something. And if you want to learn more, you can join my community using the link in the bio or using the link in my description of the YouTube video or anywhere you are seeing me from. So this is where I will draw the curtain for today. Thank you. I'll see you in my next video.